I refinanced my mortgage last night. And if you have a mortgage, please turn me off and see if you can refinance, because interest rates are going up. Without a doubt, they're going up because inflation is all around us. And governments say that inflation is not a significant issue, but they're wrong. You know, it doesn't take a rocket scientist to understand that lumber prices are at an all-time high. So are the price of real estate in many markets. Used car prices went up 10% month over month, which is the highest monthly increase in history. And the prices of so many products are going up. And so this means that governments are going to have no choice but to raise interest rates soon in order to control inflation. So how do we know, what the market expects when it comes to interest rates? So I'm going to show you. This is a lot of fun. There's something called the yield curve, which basically the government shares with us so we can see what short and long-term interest rates are. Okay, and let's go together to treasury.gov. And what we're going to do is together, we're going to make a yield curve in Excel. I'll do this really, really quickly. Okay, so let's go over here to treasury.gov. Okay. And Treasury, and I've got a bookmark, but let me go to the main page just to show you how to get there. So it's, of course, the government website here, treasury.gov. And then you click here on data and then select daily Treasury yield curve. Okay. And what I'm going to do is I'm going to take this data and create a chart for you in Excel and explain it. But before I go there, let me first of all say that this data goes all the way back to 1990. You can get the Treasury or government rates here for every single weekday since 1990. But if you click here, whoops. Yeah, if you click here, you could see the entire year so far of 2021. Okay, and basically these are short-term and long-term interest rates. All right, let's keep it simple though and just look at the current month. And I'm going to map this out for you on a chart so I can explain what it means. But it basically means what rates are going to be in the long term and in the short term that the market's pricing right now. So let me just take this here and copy. Okay, I'm going to copy just this line here. And I'm going to go over to Excel and create a yield curve, which is the easiest way to explain this and the most fun way too. So I'll paste this here and I'm going to go and insert, give me 1 second. I'm going to insert a chart. So I'm going to insert this chart here, and then I will change the chart type so we can just see that yield curve there, right there. Good. And then I'll make this a lot bigger as well. And I will zoom in a second. And oh my goodness, I talk a lot. Okay. Now for the axes, give me 1 second. I'm going to cheat here. The axes on the bottom, you've got time. So I'm going to copy that, copy, and then paste that there. There we go. And I'll zoom in 1 second. It's the easiest and fastest way to show this thing. Okay, great. That's good enough. Okay. So what we've got here is on this axis down here, we've got, and I'll zoom in slightly more. On this axis down here, we're building the yield curve. Okay. We've got time. Okay. So 1 month, 2 month, all the way up to 30 year. On this axis here, and I'll make it bigger, we've got the interest rate. Okay, so, in 30 years, the market is predicting interest rates will be 2.3%. Okay, so this is a yield curve here. And so basically, and it usually it looks, let me draw this actually, it's an easier way to show you by drawing. But usually the way it works is it looks like this. Okay, the reason it doesn't look like that is because right here, you've got 1, 2, 3, 6 months, and then here it gaps into years and then decades, okay? But basically, the way it usually looks is it looks something like, it looks something like this here, okay? That's a normal yield curve, okay? So what this is telling us here, this chart, and look at this line down here, what this is telling us is that the 1 month rate is very, very low. It's basically zero, okay? And then it's also telling us that the 30-year rate is 2.3%. And this is what's referred to as a normal yield curve. So normal means rates are low now and they're going to be higher in the future, which basically means people think the economy is going to be better in the future, many, many years from now. Now, if we see what's referred to as an inverted yield curve, it signals that things are going to be bad in the future, or the market thinks so at least. Okay, and so let me draw an inverted yield curve, and I'll explain that as well. All right, so an inverted yield curve looks something like this, okay, roughly. And basically an inverted yield curve basically says that rates are high now, okay, but they're going to be lower in 30 years in the future, right? And when rates are low, it's because the economy sucks, right? So anyway, the government cuts rates in order to jumpstart the economy. So that's what an inverted yield curve would approximately look like. Let me delete this stuff here so I can go on to the next topic here. Okay. Now, since the United States interest rates for U.S. government securities are quite low risk investments like U.S. government debt, the more risky a company is, the higher up rates will be relative to the yield curve. And I'm going to draw that in a second, but before I go there, I want to go back here and just show you quickly rates. So rates right now are about 0.01%. Okay, that's very low. The 30-year just dipped down yesterday from 2.3% the day before to 2.28, which is why you have to refinance your mortgage. Okay, but if we go back just for fun to 2019, we can see that rates were higher then. Okay, so the 1 month on January 2nd of 2019 was 2.4%, and the 30-year was higher as well at 2.97%. That is much higher than what we have now because in 2019 the economy was doing well, and I think the government should have raised rates more then, and I'll explain why in a little bit. Okay, so now let's go back here to my yield curve, and I'm going to explain to you how companies price debt off of the yield curve. They all work together. So here's how it works. So the lowest risk investments in the world, according to many people, whatever, is U.S. government investments, and that's all priced here on the yield curve. And so the government's interest rates are 0.01% here for 1 month, and over here it's 2.3%. Okay, now when companies want to sell debt, and this basically is like a debt curve, it tells you what debt rates are going to be. But if companies want to sell debt, they have their own yield curve as well. And because companies are much riskier than the United States government, what happens is they can't charge a low rate. Okay, so a typical yield curve looks like this. Okay, but if you're a company with a yield curve, and pretend the pink line there is United States government rates yield curve. If you're a company, you can't charge low rates like the U.S. government because you're more risky. So your yield curve is going to look something like this, right? And you're going to pay more. You're going to charge more in interest. Okay, and if you're a very, very, very risky company, then you sell what are called junk bonds, or high yield bonds is the politically correct term, which means that it's going to be way, way, way up here, way above this chart even. Okay, so junk bonds would sell at much higher yields, and mortgages also are priced off of this yield curve. That's why a lot of mortgage investors will look closely at the yield curve. So monitor it daily, because the bottom line is, if you want to see how rates are trending and really, really understand yield curves, you got to go to treasury.gov. Okay, and if you have a mortgage, please refinance your mortgage ASAP. Please, 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 because I promise you, the Fed is going to be raising rates very soon.